When you look at a stock chart, how do you know if you're staring at a falling trend, flashing massive sell signals, or, a deeply undervalued hidden gem just waiting to pop?
I mean, that is the ultimate puzzle of the market, right? Two traders can look at the exact same moving averages, the same order flows.
And walk away completely divided.
Exactly. Completely contradictory convictions based on the exact same balance sheets.
Well, welcome to today's deep dive. We are tearing into AMC Entertainment using verified market data as of today, April 17th, 2026.
The mission today is to really cut through all that noise. Look past the internet memes, the hype, and just dissect the hard data.
Right. We're going to look under the hood at the balance sheet realities, the level 2 order flows, and the technical structures. We need to figure out the actual mechanics driving this highly volatile asset.
And to do that properly, we have to treat the data objectively. I mean, we're dealing with a stock that carries massive psychological baggage for a lot of investors.
Oh, massive baggage. So keeping the analysis grounded in verifiable market mechanics is crucial. But before we jump in, make sure you hit like, subscribe to the YouTube channel, and it is absolutely compulsory that you leave your feedback in the comments. We want to keep this debate going.
Yeah, let us know what you think as we break this down.
Okay, let's unpack this. We have to start with the absolute raw data of right now. As of our data snapshot, AMC's latest price sits at $1.61.
Which is down about 3.59% on the day.
Right, but looking at the daily price doesn't tell the whole story. When you zoom out to the 52-week range, you see this massive gap.
Yeah, it's a really wide spread.
I mean, we're talking a 52-week low of 93 cents all the way up to a high of $4.08. Today's day range alone bounced between $1.54 and $1.72.
And that kind of violent spread tells you a lot about the liquidity. It shows the prevailing psychology around this equity. The market cap is hovering around $938.3 million.
So that classifies it as a small cap stock, right?
Right. Technically, yes, but the volume is staggering. We're looking at a 3-month average volume of 36.49 million shares trading hands daily.
Wow. Over 36 million shares a day on a sub-$2 stock.
You rarely see that kind of sustained massive volume unless there's a fierce battle happening, usually between institutional algorithms and highly engaged retail traders.
Which leads directly into the order flow data. When we look at who is actually doing the trading, it reveals an extreme imbalance.
Yeah, the level 2 data here is fascinating.
It really is. If you look at the $1.67 mark, the bid sizes, meaning the aggregated orders of people looking to buy at that price, are sitting around 800.
Okay.
But the ask sizes, the sellers waiting to offload at that exact same price, are sitting at a massive 57,800.
That is a huge wall.
Right. Looking at that bid-to-ask ratio at $1.67 is like watching a single guy trying to hold the doors of a packed subway train open. There is just an overwhelming wall of sellers waiting.
That's a great way to picture it.
Does this mismatch signal an immediate trap for the retail buyers trying to push the momentum upward?
Well, what's fascinating here is how that order book data connects to the broader point of control, or the POC.
Remind everybody what the POC is real quick.
Sure, so the point of control is a volume profile metric. It shows the specific price level where the most trading volume occurred over a given time period.
Got it.
And if we look at the historical chart, heavy consolidation happened previously in the $1.35 to $1.45 range. That was essentially the base camp where a lot of shares accumulated.
Okay, so a lot of people bought in around $1.40.
Exactly. So this massive wall of sellers you're seeing at $1.67 represents a critical friction point for retail buyers.
Friction point mechanically meaning what in terms of price action?
Meaning it acts as a literal ceiling made of supply. When retail buyers try to push momentum upward, the price inches toward $1.67, and it just slams into this massive backlog of sell orders.
So they basically hit a brick wall.
Pretty much.
Yeah.
From a structural standpoint, if you don't have enough aggressive buying volume to chew through those 57,800 shares sitting on the ask, the price physically cannot advance. High-frequency trading algorithms see that imbalance, they recognize the lack of buy-side liquidity, and they immediately start shorting the stock, which pushes the price right back down. It's the market's way of rejecting the advance.
But that massive wall of sellers at $1.67 isn't just some random psychological number, though. It's the market actively pricing in a structural reality.
Oh, absolutely. It's tied to the fundamentals.
Right, because if we want to understand why sellers are so desperate to exit at $1.67, we have to look at the bleeding on the income statement.
The fiscal year 2025 financials.
Exactly. Reported on February 23, 2026. The juxtaposition here is wild.
The financials are where the narrative of the operating business completely detaches from the reality of the corporate entity.
Yeah, because looking at the income statement, total revenue actually grew. It went up 4.5% year over year to $4.85 billion.
Which sounds great on paper.
Right. We've got massive blockbusters like Avatar pulling people back into theaters. Cash is absolutely coming through the doors, yet the bottom line is a total disaster.
Yeah, it's pretty grim.
The net loss is a staggering negative, $632.4 million. The trailing 12-month earnings per share, or EPS, is negative $1.34. I mean, how does a company gross almost $5 billion and still bleed out?
You really have to look at the capital structure.
Yeah.
Selling popcorn and movie tickets, it's a recovering business. Top-line revenue is growing, and theaters are seeing foot traffic.
Sure.
But operating a cinema is entirely different from servicing a legacy debt burden. On their balance sheet, AMC is carrying $8.14 billion in total debt.
Over $8 billion in debt on a company whose market cap isn't even $1 billion. That is insane.
Precisely. And that debt is structured with incredibly punishing covenants.
Yeah.
Just to manage that debt, AMC paid $123.6 million in the fourth quarter alone.
Was that on the principal?
No, purely on interest. Not a single cent of it paid down the principal loan.
So it's just the fee to keep the creditors from forcing bankruptcy.
Exactly. It's the minimum payment on a corporate credit card that has been totally maxed out. To put that into perspective, their free cash flow in Q4 2025 was technically positive at $43.3 million.
But it dropped significantly from the year before, right?
Right, it was $113.9 million in Q4 2024. But even with that positive $43 million, when your quarterly interest expense is nearly 3 times higher than your free cash flow.
You're just structurally bleeding capital.
Yes. Even if Avatar breaks every box office record in history, the profit doesn't go to the shareholders. It doesn't go into research and development. It's funneled straight out the back door to bondholders.
Which mathematically results in the negative equity we see on the balance sheet. They're sitting at a stockholders deficit of negative $1.89 billion.
And negative equity is the ultimate fundamental red flag.
Explain that for the listeners. What does negative equity actually mean if things go south?
Mechanically, it means if AMC ceased operations today, liquidated every single projector, sold off every theater lease, and emptied their bank accounts of their $428.5 million in cash.
They'd still be in the hole.
Yeah, they would still be nearly $2 billion short of paying off their creditors. Their liabilities vastly exceed their assets.
Wow.
The corporate entity is effectively a distressed debt management vehicle that just happens to operate movie theaters.
So fundamentally, the foundation of the house is crumbling. But if you pull up the technical charts, they are telling a highly energetic, almost euphoric story.
They really are. The disconnect is wild.
I mean, we just saw this stock post a 64% gain in a single month. That is its best performance since the 2021 meme stock era.
Which is exactly why volatility traders and algorithmic systems flock to this ticker. Fundamentals dictate the long-term destination, but technicals dictate the daily journey.
And the journey here is incredibly violent. Let's break down that journey. Looking at the key support and resistance levels, support is currently sitting at $9.50.
Which acts as a psychological round number barrier.
Right. And then there's a hard multi-month floor at $1.30. On the way up, resistance is today's high of $1.72, and then the major barrier at $2.
But the technical indicators are flashing contradictory signals across different time frames right now.
Yeah, the clash between the micro indicators and the macro trends is textbook. We have the 14-day RSI, the relative strength index, sitting near overbought territory above 70 on the daily charts.
Mechanically, that usually means the asset has been bought too aggressively relative to its recent average. So a short-term pullback is imminent.
But at the exact same time, the MASD is showing an EMA crossover.
And that EMA crossover is a critical trigger for momentum traders.
Because the MASD measures the relationship between two exponential moving averages, right?
Exactly. When the shorter-term moving average crosses above the longer-term moving average, it flashes a long signal. It tells quantitative trading algorithms and short-term traders that immediate, localized buying pressure is accelerating.
So that is what fueled a lot of that 64% monthly surge.
Oh, 100%.
But despite that massive surge, AMC is still trading below its 200-day simple moving average. So the daily RSI is like a sports car, redlining in first gear screaming hot and overbought.
I like that.
Right. But the 200-day moving average tells us this car is still losing the overall race. Are these micro indicators just creating a mirage for day traders?
That sports car analogy is perfect for understanding time frame conflicts. The 200-day simple moving average represents the track the car is driving on. It smooths out almost a year of price action.
Okay, so it's the big picture.
Yeah, if a stock is trading below its 200-day SMA, the macro track is undeniably angled downward in a bearish trend. The MACD crossover, however, is a short burst of nitrous.
Oh, wow. So day traders aren't looking at the macro track at all.
No, they're just playing the nitrous. They were trying to capture a 10 or 15% pop before the engine overheats, which is exactly what your overbought RSI is warning about.
That tension between the micro-nitrous burst and the macro downward track is exactly what feeds the massive ideological split we are seeing among investors. It perfectly tees up the great debate surrounding this stock.
It really does.
Is AMC a deeply undervalued gem ready to squeeze, or is it the ultimate value trap?
The dichotomy between the institutional thesis and the retail thesis here is honestly one of the most stark divides in the modern market.
The institutional side is decidedly grim. The analyst consensus is a firm hold or sell. The average price target is pegged at $1.72.
Which, given our current price of $1.61, implies only about a 7% upside.
Right. Wall Street is essentially looking at the negative equity and the debt burden and pricing it as a distressed asset.
Because institutional models rely on discounted cash flow. When your free cash flow is being entirely consumed by interest expenses, those models spit out a valuation that is fundamentally anchored to the floor. To an institution, the stock is overvalued even at $1.61.
But then you have the retail community, the apes, who view it as deeply undervalued.
And their thesis isn't built on discounted cash flow.
Not at all. It's built on market mechanics and speculative short squeeze theories. They're looking at the massive average volume of 36 million shares and betting that sustained retail buying pressure will force institutional short sellers to cover their positions,
Driving the price exponentially higher. And a short squeeze is a very real, very powerful mechanical event.
Explain how that works for someone who might be newer to the mechanics.
So when institutions short a stock, they borrow shares and sell them, hoping to buy them back later at a lower price.
Right.
If the stock price violently spikes instead, those institutions face margin calls. To protect themselves, they are forced to buy shares at the open market price to return the borrowed stock.
Which creates a feedback loop.
Exactly. This forced buying drives the price even higher, which triggers more margin calls, forcing more buying. That is the engine behind the retail thesis.
Here's where it gets really interesting, though. For a short squeeze to effectively trigger the supply of available shares, the float needs to be relatively restricted.
Crucial point.
But the SEC filings show zero major insider buying right now. The executives aren't acquiring shares. Even worse, the biggest downside risk highlighted in the data is heavy continuous dilution. The company is actively issuing new shares to raise cash to manage that $8 billion debt. So isn't calling this undervalued just a massive value trap if the company itself keeps inflating the float?
This is the fatal flaw in the retail squeeze thesis. And it really just comes down to basic math. Dilution in the stock market functions exactly like a central bank printing fiat currency to pay off a national debt.
How so?
Imagine a country's economy isn't generating enough tax revenue to cover its obligations, so the government just prints billions of new dollars. It instantly hyperinflates the currency.
Destroying the purchasing power of the money already in circulation, the currency fundamentally loses its value because there's simply too much of it.
Exactly. When AMC owes $123 million in quarterly interest but doesn't have the operating cash to pay it, the board authorizes millions of new shares and sells them into the open market.
Which instantly hyperinflates the stock's flow.
Right. So you can have all the retail buying pressure in the world trying to trigger a short squeeze, but if the company is simultaneously dumping massive new supply onto the tape,
it mathematically neutralizes the squeeze. The supply aggressively rises to meet the demand, effectively capping the price action.
yes. If a stock has 100 million shares and 20 million are shorted, you have 20% short interest. A squeeze is highly possible.
Right.
But if the company dilutes and issues 100 million new shares, the float doubles. Suddenly, that short interest drops to 10%. And the short sellers have a massive ocean of new liquidity to buy from.
Oh, so they can cover their positions without ever driving the price up.
Precisely. Algorithmic traders price in this dilution instantly, which kills the upward momentum. Everyday investors often get trapped because they are fighting an invisible headwind created by the very company they are trying to support.
So Where does this leave you, the listener, who is trying to map out a position? Let's outline the bull case and the bear case.
The bull case is heavily reliant on catalysts rather than current fundamentals.
Right. The bull case argues that strong retail sentiment is a persistent, undeniable force. I mean, we just saw it trigger a 64% monthly jump.
And on top of that, there are real industry tailwinds.
Yeah, there is significant momentum regarding a potential merger between Paramount and Warner, which could stabilize the broader studio system.
And streamline theatrical release windows.
Couple that with massive blockbuster releases that continue to drive record top-line revenue at the box office, and you have a recipe for algorithmic momentum.
The core of the bull case is that if the company can simply survive long enough without going bankrupt, the underlying theater industry will recover enough to allow them to restructure that $8 billion debt.
Under more favorable terms, right.
Yeah. If they announce a major debt restructuring alongside a strong earnings beat, the stock could see a violent, sustained upside re-rating.
But then there's the bear case, which is anchored in the math of today. The $8 billion debt ceiling is suffocating.
Extremely.
You have negative equity where liabilities vastly exceed assets, and you have the constant mechanical threat of dilution hanging over every single rally.
Because every time the stock price pops 20 or 30%, corporate treasurers are highly incentivized to issue equity to raise capital.
Which immediately crushes the rally.
Exactly. If we connect this to the bigger picture, your outlook really depends entirely on your time frame and your risk tolerance.
So short-term versus long-term.
Yeah, the short-term trend here is a bullish, highly volatile momentum play. It is fueled by industry news, retail sentiment, and technical bounces off support levels.
It's a day trader's paradise.
It is. But the long-term perspective remains heavily, fundamentally pressured by the balance sheet.
So it's the classic market dilemma. Do you try to ride the short-term wave of a blockbuster summer and meme-driven technical spikes? Or do you run from an $8 billion debt monster?
Well, a stock can be a highly lucrative short-term trading vehicle while simultaneously being a fundamentally poor long-term investment. They aren't mutually exclusive concepts.
Right.
AMC is a high-risk momentum play that requires incredibly strict risk management.
The tension here is incredible. You have this constant push and pull. On one side, the relentless enthusiasm of retail traders who refuse to let the stock die, constantly pushing the volume and fighting the tape.
Yeah.
On the other side, the brutal, cold realities of a balance sheet that demands hundreds of millions of dollars in interest payments just to keep the lights on.
And as we dissect these highly volatile momentum plays, it is vital to remember that analyzing order flows, debt covenants, and moving averages is strictly an exercise in data analysis. Absolutely none of this is financial advice.
Always define your own risk parameters before stepping in front of a ticker that swings 64% in a single month. But here's the final thought I want you to mull over, building on the mechanics we just mapped out.
Let's hear it.
If AMC's continued survival is intrinsically tied to diluting its own equity to feed an $8 billion debt machine, what happens on the day the retail investors finally decide they're tired of absorbing all that new supply?
That is the big question.
Does the music abruptly stop, or is there one last blockbuster twist written into the algorithms? Keep questioning the data, and we'll see you on the next deep dive.